What's up, guys? I'm Nobody Special, and we had some big news coming out of the Federal Reserve yesterday, and it may have cleared the runway for gold and silver to really take off over the next few weeks. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. Yesterday, Uncle J Powell at the Fed took an ever so tiny little baby step in a more dovish direction, and the market took that and ran with it. Now, there was a lot to digest in the Fed press conference yesterday, but I want to touch on a couple of the key points. The first is that Powell mentioned he's in no rush to taper. Now, the market had been very wary because last month, you remember, J Powell announced that he was finally talking about tapering. Well, yesterday he mentioned tapering, but he mentioned that he's not in a big rush. And the market took that as a dovish signal that the Federal Reserve is going to continue in the near term with their at least $120 billion a month worth of purchases in U.S. Treasuries and mortgage-backed securities. So the Fed said they're going to keep suppressing these interest rates and they're going to keep propping up the housing market. Another takeaway I had from J Powell's press conference is he finally blessed us all with a definition of transitory. Now, what he said should come as no surprise to anybody, but it should come as a surprise that he actually said it. That's a big difference. What J Powell said when he defined transitory is he said that prices are going to rise and then they're going to stop rising, but that they're going to stay elevated. So he clarified that when he referred to as inflation as temporary, that those prices are not going to go up and then come back down. He specifically said those prices are going to go up and they're going to stay up. And maybe they stop rising, but they're going to stay up. Now, everybody knew that, right? I mean, nobody thought we're going to have inflation and then the prices are going to come back down. Now, maybe extreme cases like used car prices may come in a little bit. Lumber prices obviously came in a little bit. But the fact that Powell specifically mentioned that the prices are going to go up and they're going to stay up, that is a change in his tone. And remember, the market moves in big steps in different directions just based on the inflection in Powell's voice. So to put all this in perspective, I want you to go back a few months ago to like January, February, right? Where Powell was giving his speeches and he was saying inflation remains well below our 2% target. And then inflation crept up a little bit. And then he said inflation is at or around our target, but we may want to let it run hot for a little while. And then a few months later, the CPI reads came in a little higher, and now Powell's saying inflation is a little higher than expected, but it's going to be transitory. And now yesterday, Powell is saying prices are going to go up and they're going to stay up. So I want you to notice this very gradual creep and what Powell is saying and how he's defining things and the ever so gentle massaging of the narrative around inflation where Powell is tiptoeing around the subject and giving himself an out. I interpret this ever so slow drift in Powell's language as Powell saying, inflation is going where it wants. I have no control over it. I'm just going to let it do what it's going to do, and then I'll change my talking points later on. Now, the last big point that I want to bring up in what Powell said yesterday was he established a permanent repo facility. He actually established two permanent repo facilities, one foreign and one domestic, but let's just suffice it to say that he's established a permanent repo facility. Now, that is a big deal. Now, right now, unless you've been under a rock lately, you know what's been going on with this reverse repo situation, right? We're closing in on $1 trillion a day in reverse repos. Right now, the market is flush with cash, light on collateral. And we talked about this in a previous video, how the government has been spending down the Treasury General account, but not issuing a lot of new bonds. So all this money is entering the system, but there's no new collateral entering the system to offset it. So the banks are in this tight position, especially considering that the supplementary leverage ratio exemption was removed back on March 31st. Remember, we did that video showing all the changes in the bond market around March 31st. Well, what the Fed is doing now is they're putting the infrastructure in place for the opposite problem. They're getting ready for a market that is collateral rich but cash starved. That's a big deal because what's going on, the Treasury General account is getting drawn down and the exemption to the debt ceiling is about to expire. Janet Yellen has been talking about some emergency measures she's going to have to take if they don't extend the debt ceiling. And given the condition in Washington and the political brinksmanship and the partisanship that's going on, they're going to wait until the very last second to raise the debt ceiling before they raise it eventually. That takes us like into October timeframe. Now, when that happens, you are going to see a very rapid about face. That script is going to flip, and we're going to go from a market that is cash flush and starving for collateral to all of a sudden the Treasury is dumping huge amounts of collateral onto the market, and the market is going to have a hard time digesting all that collateral. They have the cash now, but as the government borrows more and more money from the economy may struggle to supply it, and we could end up in a repo crisis like we had in the fall of 2019. So what the Fed is doing with this repo facility is they're putting the plumbing in place to basically on the spot print money and repo it into the market at any given moment to avoid that interest rate shock that we got in the fall of 2019. So the Fed is front running a liquidity crisis. So it's going to be important to keep an eye on that. My takeaway is the problems in the banking system are getting worse. They're not going to get better. And the Fed just basically gave themselves a green light to print infinite money whenever they want to and loan it right into the market on a day-to-day basis. Now, all of these things that the Fed said and did are very dovish. It's symbols of very loose monetary policy. More printing, more inflation. Now, I did a video a few days ago about the price of gold and how all the fundamentals were suggesting that there was a lot of upward pressure on the price of gold. But the one talking point, the one sticky fundamental that I'm not a fan of, the Dixie, the dollar index, was still a little bit elevated, relatively speaking. Well, since that meeting yesterday, the Dixie has come in quite a bit. So what the Fed did with their dovish commentary yesterday is they have cleared the runway and they have lit the fuse underneath gold and silver. And in my opinion, gold and silver are going to run pretty hard, pretty fast over the next couple of weeks, right up until we get near that options expiration and that contract maturity. All right, so let's look at some of the charts here. Here we're looking at a 7-day chart of gold, and you can see right around 2 o'clock, 2 p.m. Eastern time yesterday when the Fed gave their message, look at that move in gold. I mean, so clearly the gold traders liked what Jay Powell was saying. Pretty steady, straight move up. A little bit of a pullback at the end of the day today. I'm not too worried about that. While we're here, let's look at my favorite of the shinies, silver. Again, here we are, right here around 4 o'clock or 2 o'clock yesterday, Eastern time. And look at that beautiful move up in silver. A little bit of a pullback at the end of the day today. All right, so the precious metals definitely liked what we saw. So if you saw my video the other day, you know I really like to use real yields as my indicator of gold and silver price direction. And at the time I made that video, we were right here around minus 1.11% on the 10-year. And that's real yields, the 10-year bond minus the rate of inflation. And as you can see, we've continued to march upwards since then. Here we are, again, an all-time low, minus 1.15. And we see that in our TIPS, Treasury Inflation Protected Securities. Here we are over here. This is a 1-year chart, minus 1.15, all-time low. And I want to put that in perspective. Again, the all-time high in gold, that 2103 or 2120 that we hit on August 6th, we were right here on August 6th, minus 1.08. So here we are, our real yields well below where we were during that all-time high. And looking at this chart, I think the monetary metals just have a lot of room to run here. There is a lot of interest rate pressure upward on the price of gold and silver. Now, if you saw my video a couple days ago about some of the upward pressures on the price of gold, you might recall that the one sticky point was the dollar index. And how I hate the dollar index as an indicator, but I will entertain these market gurus and these financial press guys who say the Dixie is an input to gold price. Well, that was the one indicator that was not pushing gold higher, or at least wasn't suggesting it go lower. And look at what the Dixie did yesterday. Again, right at 2 o'clock, right as Jay Powell makes his dovish statement. And we've been going down steady ever since. So the last little petty argument that anybody had against gold prices moving upward is now heading in a direction favorable to gold prices. And we'll look here. Let's look at a 1-year chart. Here we are in a 1-year chart, right? See, we've been kind of range bound on the Dixie, but we're down right below 92 here. Let's go August 6th, that all-time high in gold. Where were we on August 6th? 92.79, significantly higher than we are right now. All right, so if dollar strength is your bearish case for gold, well, don't quit your day job if that's the case. Because, number one, the Dixie is a terrible indicator because it does not measure how much stuff your dollar buys. It just measures how many other lousy currencies your dollar buys. But number two, look at this chart. Does this chart suggest that gold should have been in this steady march down it's been in since basically a year ago? No way. And I mean, look at this chart here. Here we are on August 6th. 92.79 on the Dixie. Here we are today, almost a year later, 91.9. Now look at this 1-year chart of gold. Give me a break. I mean, when the Dixie was 92.9, we were up here. And now here we are lower, so we have a weaker dollar now. Yet look at the price of gold. Gold has a long way to go. It has a lot of room to run upward. All right. So now that we've looked at some of the indicators and we've made the case that, yes, all of the fundamentals, right? Real yields, tips, the Dixie, are all in favor of higher gold and silver prices. How could you invest this or how could you trade this? Now, let me preface everything by saying I am not a financial advisor. I want you to do your own research, your own DD, arrive at a decision that's right based on your unique situation. That being said, if I were to invest or to trade this, well, those are two different things. First of all, if I were to invest this trend, I would buy physical gold and physical silver. And that has always been my investment strategy when it comes to gold and silver. I hold it, I own it. I don't mess around with derivatives. I stay away from SLV and GLD. All right. If you want to invest, if you want to preserve your wealth, buy and hold, then there's no substitute for physical gold and silver. Now, if you wanted to trade this trend, because my personal opinion is the bullion banks are going to let gold and silver prices rise for the short term. And by short term, I mean 2 to 3 weeks. I think all these indicators right now are incredibly favorable to gold and silver. And I think they've set the table where they're going to allow the price to rise as it naturally wants to. And where I think they're going to go is, we've seen their playbook before, right before options expiration, right before those contracts mature, they smash the price down. They do their paper dumps. So that gives us a couple of weeks, right? You've got options expiration on the 20th for the ETFs and for your stocks. And then you've got options expiration on the 26th, I believe, for your futures options. So let me preface, if you wanted to trade this, you want to be out or at least take some profits prior to those days, because we've seen those smashes before, all right? And to expect them to not happen now is not a reasonable expectation, okay? If they've manipulated the prices down before, they'll keep doing it. So what I've been doing is I've been buying into SILJ. That's the Junior Miners ETF. Looking at this chart, this is going back to February. You can see SILJ has been beaten down pretty heavily recently. Had a nice run up the last couple of days. Again, I think it's got room to run. So SILJ is one way you could trade this. Again, just prior to those options expiration, I would want to take profits because we can expect a price smash sometime in the middle to late part of next month. Another way you could play this trade would be a GDX. That's your Gold Miners ETF or your GDXJ. Again, you can see these have been beaten down quite a bit. Nice little run here the last couple of days. I think they're going to run for a few more weeks before they get smashed down. Looking at a 1-year chart, I mean, look where our miners were a year ago. I mean, if we zoom out, look where our miners were a year ago on that August 6th. 44.2, 44.20. Where are we now? 35. I mean, these miners have a long way to go. These miners are free cash flow machines right now. They were profitable when gold was 1,600 and silver was 15. They're immensely more profitable now with silver at 25, 26, and gold at 1,800. And if you must know, there's a reason why I just brought up the chart of SLV, because SLV is the key instrument of manipulation besides dumping paper contracts. This is how the bullion banks manipulate the price. And if you want to know how far they're going to let it run, you go to your options market, you look at your next expiration in August, go to your monthlies on the 20th, just go down, look at some of your open interest. Look at that right there, 2650, 132,000 contracts open. The bullion banks will not let those contracts expire in the money. Mark my words. It's July 29th. I want somebody to quote me, and if I'm wrong, you can come back on Twitter and beat me over the head with it, and I will put it up on one of my videos, just doing a mea culpa. But I'm going to go out on a limb here, and I'm going to say there is no chance that JP Morgan and the other bullion banks let those 132,000 SLV calls expire in the money. That's about a $2.50, almost a $3 run from here. So looking at where silver is right now, 25.5. That tells me silver probably going to go somewhere around $27 an ounce, maybe even start threatening that $28 level again. Again, they'll smash it down right in the middle of next month. So again, I'm not an expert. I'm not a financial advisor. That's just my take, and that's how I plan to play. I bought some call options in SIL-J. I plan to be out of those options by the middle of next month. So to make a long story short, the Fed came in slightly more dovish yesterday. They established this standing repo facility. They've announced that they're in no hurry to taper. So all of those things have put downward pressure on the value of the dollar. They've put more upward pressure on the price of gold and silver. I think we're going to see precious metals run here for the short term, at least right up until that options expiration and that contract maturity. At that point, we can expect the bullion banks to play their stupid games like they always do and smash the price down. So if you're a trader, keep an eye on that. If you're a long-term buy and hold investor, it shouldn't matter to you that much. Guys, I want to thank you for your time. I really appreciate you coming and checking out this video. If you liked it, please give me a thumbs up. Consider subscribing to my channel and hitting that notification bell. It would really help me out. In the meantime, live small and dream big.